Get your questions ready because it's Ask Me Anything Hour, which means we get together like the Brady Bunch to answer your questions about money, taking back control of the money, or your financial mess you're in and you just need to see the way out. So whatever it is, we're here to answer those questions. We'll be right back after this little video, which needs to be updated. All right, we are at it. It's another week where we answer your questions. We just wrapped up, I think, a pretty epic wealth webinar, but I think they're all pretty epic. Today was good because it was real. It was a webinar we did talking about real problems our clients are having, and we just addressed it live, and we just showed the mathematics. And even for me, and Craig, I don't know if you agree or disagree, and Steven, same with you, like for me, I always thought I knew the answer to that question, but I never mathematically proved it. And that's what you were able to do today with the freak in the sheets actions. You were able to actually show us the math behind the magic of infinite banking concepts and some really cool, I would almost call them like secret hacks that people can use to make more money while performing the infinite banking concepts in their life to take back the banking functions. But nonetheless, I'm going to shut up and I'm going to allow everybody to go around the block here, starting with that guy.
That guy's Mr. Snaggy.
Yeah. Hey, what's up, everyone? It's another happy hour, another beautiful Wednesday, and we're here to answer your questions, guys. So it's been good shows today. What the F this morning? Oh, so much going on in the news, so much going on with just everything, with the markets, with the tariffs, with past presidents, with current presidents, and everything else. Wealth webinar was really cool today. I hope you guys enjoyed that one. But get your questions in over there, and we're here to answer them all. Thanks for being here.
I'm going to take it, and I'm going to point out that Joe's wearing a hoodie, and I just cranked the heat on in my house because I'm freaking freezing over here.
It is damp out here.
Man, you took my thunder, Sean. I was going to say, you guys all look cold, and it's like 100 billion degrees in Florida right now.
It's not that cold here. It's just damp.
But yeah, excited. I feel like I got a reunion today on What the F with everybody that was at Money Tank last week. And the Wealth Wednesday webinar was super good. I'm excited to do Ask Me Anything today. So I'll pass it down to Brian.
Hey, everybody. Brian Fouch here. Yeah, it's damp here too, actually. It's dark clouds and cold and yuck. So, yeah, supposed to be nice weather next week. So looking forward to that and all the mosquitoes that it'll bring. So with that, I'll go over to Ethan.
Hello, everybody. Ethan Evans from the implementation team and also Money Mentor. Excited here to answer your questions and help you rethink your thinking. So I'll go over to Craig.
And good afternoon, Craig Yenny here. So, Chris, you were mentioning the wealth webinar. I think one of the things that I really enjoyed doing on that one is showing the difference between the HELOC interest versus the policy loan interest. And I mean, it's just a little minor difference, but just when people understand how the interest rates flow on the policies, it's one of the best tools out there, just hands down. And then you couple it with a HELOC and you've got a powerhouse. But anyway, that was the fun part for me. Brent, I just saw your message. That is so awesome. Congratulations. Joe and I have been working with Brent to get, some COLI policies put in place. So those are up and running. So kudos to you and the team.
Yep.
But other than that, I'll go down to Jason down here somewhere there.
There I am. Here I am in Orlando, where it's very warm, and excited to be here answering questions as always. Excited to be here with the team. And I don't have much to say today. Not much on my mind. Just there's a lot of people being helped. And I guess the freak in the sheets with his math. That's always fun to say. Just get in there a couple times during the webinar. And over to Joe, because he likes to laugh. And if you want to make Joe laugh, what do? You just disappear. Where'd I go? Joe. There he is. Over to Joe.
I'm freezing up here, and I want it to be nice and warm like it is in Florida. Not that I get out too much because I'm behind the computer and running numbers for HELOCs and policies, helping everybody. So I'm going to leave after here, and we're going to go shooting. So Ariane has to shoot tonight. So
Sweet.
Let's get those questions in and let's get some answers going.
Joe,
Somebody
you need to get yourself a little space heater.
And Sean, I do have a question too that came in from one of my clients today too.
Yeah, let's start with that because we only got 2 in the chat so far. So let's start with your client's question.
Yeah. So this client, they have a roof damage. So in April, their roof was damaged by a storm, and they have a $19,000 check from the insurance company that has been sent over to them. The roof has been covered, and they're waiting for the weather to clear up so they can actually do the work, the contractor. So her question was, and she's getting conflicting answers from other people, is if she checks or cashes the check and doesn't use it for the roof, maybe puts it into a policy, are there any issues with the existing insurance company that's covered her home, possibly dropping coverage or any legal issues if the money doesn't go directly into the roof?
Wow. I mean, technically, you got to deposit the money in a bank account, right? You can't just go directly from insurance company to roof. So
it's in their personal name, correct?
Yeah, it's in their personal name. You could always check with the insurance company if they would care. I don't know why they would. I don't think they do care. But
no,
again, I wouldn't want to give a definitive answer just from a legal standpoint, but check with the insurance company. But I can't see why it would matter.
The only concern I would have is that if you don't put it into the roof and you don't fix the roof, the insurance company might drop coverage with you because
absolutely, yeah, they would absolutely cancel your insurance if you don't fix the roof.
Yeah.
So I've had 2 roofs due to hail in the past, and what they did in my situation is once I got my contractor, they would get validation from the contractor that a certain part of the job was done, and then they would release the funds so I could pay the contractor.
Yep.
But I don't know if a lot of insurance companies just write checks anymore for that reason.
Yeah, I've had it happen on cars here in the last couple of years. So that was their question. The other issue they have is they want to get a HELOC, and they're working on some credit issues to get that. But they realize that they probably have to have the roof fixed before they can go apply for a HELOC, because a hole in your roof isn't going to be a pretty good idea when you're trying to get your home appraised. So a lot of moving parts and pieces. So my response to them was, we'll ask it on this. They didn't want to have it be publicly asked, their name, by the way. But additionally, I just said, hey, proceed with the policy, and then however everything works out is how it's going to work out. Because the timing, they're trying to figure out the timing of the contractor and all this kind of stuff. And so this is for everybody here, is just get all the options on the table, and then whatever makes the most sense will make the most sense. But if you don't do the policy today, you don't start the ball rolling, you're not going to have that option on the table. So they're going through the hoops to go get the policy approved, and then they'll see what happens. So there you go.
Yeah. Like you, Brian, my mind was thinking, I've definitely heard of people doing that with cars, but it's not like you're going to ask for a HELOC on your car. So that HELOC portion, I feel like makes you think to get the roof fixed.
Yeah. I got a check for $2,000 for my motorhome that somebody hit, and then I went and fixed it myself and cashed the check.
I think if anyone, for any scenario that comes up like this, I think the most important thing to think about is the thinking, like where are we storing the funds? Are we storing them in a bank? Are we going to store them inside our policy? And what protections, guarantees, and things do we get from where we're choosing to store our money?
Yep.
So you want to have the most control and the most options. So like Brian, if they did do that, even though you don't know what's step 2, 3, 4, 5, and 6, if they're able to have liquid funds available for when they need them, and they're in the policy and they're protecting the family and they're guaranteed growing and everything else, and why wouldn't you store them there? Right.
Yeah. And one of the issues on this one, this is for everybody who's listening to this as well. The policies are not done in 1 week, and then you have access to the capital in week 2. So there is a time, duration you've got to keep in mind when doing infinite banking as to when you need it. Because I've had a lot of clients that say, "Oh, I need to have it next week." I'm like, "Well, you should have started 2 months ago. Get the ball rolling." And so it's that one thing. It's that thing. We always wish we started 20 years ago doing infinite banking. Everybody says that. At the same time, how many people have we talked to that says, "Man, I wish I started this 2 months ago when I first was learning about it, and I just procrastinated, and now I need it and I can't get it." So that's just one thing. I've had that conversation way too many times in the last month. So
that's the mindset of Americans, right? I had a guy from France, been living here for 14 years now, and he was uncommon with his savings, making like $200,000, but he was saving about 30%, like $6,000 a month.
Wow.
Right. And I was like, wow, that's impressive. And he's like, yeah, I don't know what it is about Americans. You guys make a lot of money, but you don't like to keep any of it. You just want to spend all of it. And that's kind of the mindset we're fighting with, thinking long term being the first principle of infinite banking, right? We're helping people see what they actually want down the line, but they have to have the discipline and delay the gratification to get that next deal. Like a lot of people you're probably talking about, Fouts, are investors where they want the money, they see a deal, they have to do the deal, they want to get the money in, get it back out and get it moving, versus just like building the opportunity fund, waiting for the next deal that comes to them and then moving.
Well, exactly.
All right, love it. Oh, and then one thing you guys reminded me of when you brought up like getting started and thinking in advance, but then also just to speak to those other people that like have the medical and all that stuff and are approved, and then they wait and wait and wait, and then they almost time out. It is like this really delicate like time frame. So you don't want to start too early. You want to make sure you're ready. And then you actually act when you should be acting.
Yep.
All right. Shane is saying Chris's FIA video sparked a question. In the $100,000 example, would it be possible to do a $50,000 dump in and then use the other $50,000 to put in the SPIA to fund the policy for 10 years? And he has a
that's a good
second
idea.
question.
As long as the money kicked off by the SPIA would be sufficient to cover the premium deposits, and you would run a SPIA first and figure out what kind of is the need, and then go from there. But yeah, you could chop it up any which way you want. That would solve the first option's problem of liquidity, because you now have the 50K as liquidity because that's a PUA dump. The other 50K is working through the SPIA to produce the premium deposits. So now it's kind of like doing a single premium, because it's the same idea, except for now you got liquidity. I don't know why we didn't think about that, Craig. That's smart.
We did a use case similar. The folks up in New York, I don't remember their names, probably don't want to say it anyway, but they were using some of their money for a SPIA to fund the policy, take the money out of the policy to pay off some family debt. Mm-hmm. But yeah, there's a lot of cool ways of stringing that together. I like the way Shane's thinking there.
Yeah, I mean, that would definitely work. You just have to run the math, make sure the 50 would produce enough, which I can't see why it wouldn't over 10 years.
Yeah.
And for those of us who don't know, is SPIA a single premium?
Immediate annuity.
Instant income annuity.
Okay.
Instant income annuity. I'm not sure if that's compliant, but sure. Instant income, because it definitely could be instant.
Yeah.
Yeah. So typically those are where you're just going to put a lump sum in and then turn on the income so it starts paying out.
That was a great way to get a guaranteed income stream, and then the interest rate on those right now is, or the what do they call it? The crediting rate. I don't think they call it an interest rate. They call it the crediting rate, is really, really good because of the high interest rate environment.
And then who's like the avatar or the good person to use that? Like there's the IBC policies and then the SPIAs, and who should be doing what? Can you be doing both?
Typically, that was kind of a different kind of use case. Typically, you'd only use a SPIA in retirement planning. I'll give you an example. Back when I was an advisor, we had this very wealthy client who went through a divorce. And, I mean, he was really wealthy, and he lost. Well, he didn't lose, but the divorce settlement came out, and his wife had this huge alimony check that he was going to get. And I remember vividly sitting in the conference room and him saying, "I physically cannot write this check to her. They're going to throw me in jail. I can't do it," because he just hated her. There was a lot of animosity there. And we said, okay, well, what if you didn't ever have to write a check, but she still received her alimony and you had to put less money in? Would that be a win for you? He's like, yeah, what do you mean? I'd never have to write a check. You never have to pay a check ever. You just have to, come up with the money, put the money with us, and we'll make sure that a check gets paid. He's like, so you guys are going to do that? I said, no, the insurance company is. We would take the money, we'd put it in a single premium annuity for lifetime. It would pay out for her entire life. If anything ever happened to her, the balance of what wasn't paid out would be paid to her kids, which was his kids. I should have said his kids. And the insurance company will write the check every month. But because you're doing it this way, the insurance company is going to pay you interest every single month on your money. Therefore, you have to put less money in to make this happen. He was thrilled. He did it. He wrote the check, smiling all the way out the door, thinking he just got a victory. So you could use it to settle with your spouse that you just divorced from, or you can use it for retirement income planning because it's guaranteed income. I just remember, I'll never forget that because that was such a rare situation that the hate was that much. He physically couldn't write a check.
Sounds like somebody's getting
some child MMA going on.
yeah, someone's getting beat in the background.
Not me today. Shane has a second question. He's saying, is this also a way to get around the maximum insured value using income as the cap value? 30% or so of your gross income. Unsure if this question is worded properly. Thank you.
It's not, but I get it. Yeah. So it would get around that because the income is being created from the lump sum. So therefore it's not taking away from any of your human life value or any of your gross income requirements, because you're literally creating an income out of thin air using a lump sum of capital. So instead of it being an asset, because the insurance companies look at the income and they look at the assets, but they more heavily weight the income. So it would produce new income. So yeah, your thinking is correct there.
So Chris, that would raise his total amount of income, raising his insurability. Is that kind of what the point is?
I don't know if it would raise his insurability. Maybe. I mean,
well, if his income
hypothetically, it would raise his insurability.
Yeah,
but
if his income goes up, then whatever the multiple is for his age would be how much more insurance he can carry on his body.
The easiest way to think about it is it would just be his premiums that go into that policy that the SPIA is funding is kind of a wash. So whatever his insurability was prior based on his income, it would not change from that because we're creating an income.
All right, I love it. And then we only have one other question right now, and I see our viewers are a little low today, so I don't know if that's us being missing for a couple of weeks, but get those questions in here.
I don't think
I don't know.
We've been going.
All right. But Terry's HELOC is in underwriting right now. And then their question is, can whole life policies be written for people with health issues?
It depends.
Depends on what the health issues are.
I mean, realistically, there's guaranteed issue policies, but I'd never write one.
Yeah. So Terry, if you have concerns, like it's best to get a call with someone, share what your concerns are, get as many details as possible. Then we can bring them to the preliminary underwriting and find out if you're insurable or not. And if not, there's always other insurable interest if you have them. So that's a typical approach. Like if someone we're helping doesn't get offered, the partnership doesn't get offered insurance, then we're still usually meeting with them to see if there's other insurable interest. What is the next potential solution to helping them? So we can keep going. Anybody else?
Yeah, this is very, very low attendance and a lot.
Yeah, I just had someone get approved tobacco table D.
Oof.
And that was brutal because it was a husband wife. He got denied for multiple reasons. Height and weight was out of whack, diabetes, medications. And then she didn't say that she was a smoker. She said she's never smoked in her life, but she got a tobacco rating. So I'm trying to figure that one out. But past diabetes doesn't.
You can fight that, Brian. You can fight that, and you need to fight that.
Yeah, I haven't. Yeah, it just came through in the last hour.
Fight that. You'll win.
Well, it depends on. I need to ask the client why she would have had a tobacco rating, because oftentimes we find that
well, there was this one night. I didn't think that would matter.
Yeah. So, but the tobacco rating was there, but also the table D. So what we had to do to make it even work, I just did the illustration a few minutes ago. I had to lower the dumping by quite a bit, and it's just not. I'll be honest, it's not a very attractive policy. So the answer to that question is yes, we can with health issues, but it's not going to be as efficient of a policy as a standard rating or a preferred rating. So
yeah, a lot of times what Brian, like what you were just talking about, like with a dump in, that the same insured, whatever the rider is that you're using to do the dump in is going to be astronomically expensive. So a lot of times it doesn't even make sense to do a dump in when someone is that low rated and tobacco rated, right? Because they're basically putting all the money towards term insurance to be able to do the dump in.
Yeah. It was unfortunate. So like the PUA portion is less than the base. and the PUA is about equal to the term right now. So it's just not attractive, but we'll see. So, but I want to talk to the client though first. I actually have had a client that got a table C and then went back and got a standard rating.
Yes.
So they did it within 2 weeks. Carnivore diet. So if they were on the carnivore diet and they did a barbecue hopping thing the night before their exam. So they went to 5 barbecue joints the night before their exam. And this was a 120-pound woman, and her cholesterol and everything was through the roof. So she went back and had it all redone and got it taken off.
Yeah, and a lot of times, we discuss this a lot. If someone gets a highly rated case, get a preliminary offer from another carrier like SML and see what that comes in at. And if multiple carriers come back with like a heavy rated case, I always got to have that real conversation with the client to say, hey, listen, like, I know these numbers aren't what you want. I know this isn't as efficient as you want. I know it's not going to do what you want, but like, this might be your very last chance to ever get coverage for your family. So I think we need to think about that, because listen, if you get a heavily rated case like that, like, listen, I don't mean to say this, but like, there's something ain't good. Something's not right. And if the insurance company is rating it, they know you're not going to live as long. Like, they just know that. That's their job. The actuaries literally can tell you when you're going to die. And I know that's morbid and everything, but they can very accurately tell all of us when we're going to die. So if they're rating you heavily like that, it might be the last offer you ever get to have life insurance, unless something drastically changes in your life.
Yeah.
I love that, Chris. I had someone the other day who first got rated for standard. Then we went to do a dump in and they had to do the EKG, right? Because it raised the insurability by quite a bit. Came back rated table F. And so I talked to him about it. He showed me like the message from the doctor about his EKG and an abnormality. But he's like, I was telling him the same thing you were just saying. I'm like, look, you should take this, get your medical stuff in order, figure it out later, get the rating improved. Because if you're getting rated that low after doing this, you have something serious going on with your health that you need to take care of. And he's very much like, oh, I'm healthy. I'm in good shape. I'm good. I'm like, man, I hope you don't not take this with that being how we left it, right? Because it's not working for his financial needs.
Yeah. Red flag.
Yeah, it's a huge red flag. And I didn't know, I was like, how would you guys approach that? I was really, really direct with him and said, look, you got daughters. I know you look like you're really healthy and everything, but if your EKG is abnormal, you should probably have some more follow-ups and figure out what's going on.
I had a client, and this is, just unfortunate, very high net worth individual, athletic, outdoors person, had a huge business, successful in his 40s, had the medical scheduled, and he decided to go to his primary care to have a physical before he did the medical for the life insurance, just to get a preliminary numbers, prostate cancer. And, fortunately it's very early when they caught it, but yeah, it was very aggressive type. So they were doing surgery within a week, doing surgery.
Wow.
You just never know, so yeah, take those exams. The result there.
Another factor to consider too in a rated case is, if you got rated, maybe it's something circumstantial, something you're working on. Like, take the case at the rating, and then next year go back and get retested. The insurance companies will allow you every single year to get retested. And then if things improve, like I've had a lot of clients, like they were losing weight and they were in the gym and everything, and they got rated because of weight, a little short for their height. And they just came back the next year and got it re-rated. I've seen people go from a class, like a rated, heavy rated case to a preferred rating. And I've seen tons of people go from a smoker to non-smoker. And
is that the same exam process as in the beginning?
Sometimes it's not. Sometimes, like if it's just a smoker rating, they don't even do the full thing. I can't remember what they did. But no, back then we used to do swab tests, believe it or not. We literally in the field used to administer swab tests. Can you imagine that nowadays? Holy smokes.
Very good job, guys. We have a few questions now. And then, Chris, if you're able to open that box, Damien's on right now as well. But I'll start with this first question. So Gloria is saying, so am I able to take out my husband's pension, which would be another 3 more years, a good 400,000? If I put it into a designed whole life insurance, will it take care of us for our whole life?
So I need a clarifying question on that one. Are they asking about, you think they're asking about taking the pension out and putting in the whole life and then taking income out of the whole life? I think that's what they're talking about.
Yeah, I don't know enough from this question, but I feel like, and what I've heard from pensions is they're good, but I don't know.
It sounds like in 3 years, the pension will be worth $400,000. And they're asking if they took it out and put it in the whole life, would it take care of them for the rest of their life?
I would say it's a mathematical calculation, but
Yeah.
a pension's an income. And if you put the 400,000, the pension was paying you, an income into a policy, it's never going to pay out the same amount. They're two different animals.
Yeah.
It'd be like saying, hey, can a cat bark and can a dog meow? Maybe. I've never seen it, but you wouldn't want to do that if it was an income play. You'd have to be a reason you're putting it into the whole life and to do that. I typically would never allow something like that if I'm reading the question right.
Yeah.
I've had people do the same thing with the 401k. Oh, I'm 59 and a half. I can take my 401k out and put it in here and provide income. I go, that's the two different vehicles, two different purposes. And from my experience, the whole life has to be there for a while before we can start doing that. So it's not designed for instant income in most cases.
Yeah, and whole life is in this whole concept in this process is like an add-on to whatever you're doing. So it's like an add-on to your income. It's something else. It's not going to replace anything, I don't think. So it's just something, if you can do your pension and this at the same time, I feel like that's the thing that you'd want to try to see if that's possible or go down that road.
Do whatever solves your challenge the best. That's the best answer.
I mean, sometimes I will say this, sometimes it's worth looking at the pension payout that the company's offering you, and then run that with an individual SPIA and see if the SPIA pays more than the pension does. I mean, I've seen that work out in favor because then it's the same exact thing, but you're doing it independently. You're not relying on the pension. You're taking a lump sum from the pension, putting it into a SPIA. If the SPIA kicks out a higher income, then great, but you'd have to just run the math.
Will there be tax consequences though too?
No, it'd be a direct rollover, qualified to qualified.
A little bit. Okay.
So that's cool. And then earlier you kind of hit on that SPIA was another different animal than a whole life policy.
Oh yeah, totally different things.
Shane is saying one of my family members has a large 401k that is in a union, let's say 200,000. Is there an outside line of credit that can be taken against the value of the 401k, like an asset line of credit? Because there is a loan available through the 401k, but it's capped at 10,000 unless the loan is specifically for a home improvement or home purchase.
Holy crap! The $200,000 401k is capped at 10K. That sucks. I don't know of any banks that would issue a line of credit because the biggest issue you're going to have there is the 401k is protected. So in light of judgments and all that stuff. So there's lots of protections on 401k assets. So most banks wouldn't touch that with a 10-foot pole.
Wasn't there also the volatility too? Is that another reason the banks wouldn't issue?
A lot of reasons, but primarily because there's no protection. They can't collateralize the loan with the 401k balance because there's so many rules to protect 401ks that they would never be able to collect the assets. And you can't collaterally assign a 401k asset, and you can't change ownership on a 401k asset. So it's not like the policy where you could collaterally assign it. You can change ownership. You can't do that with 401ks. It's a good question. It's just the answer is no.
All right. And then Chris, do you have that box right there from Damien?
Yep.
Yeah. So Damien, one of our frequent Ask Me Anything YouTube subscribers, sent us a box. We're going to see what's
Drum roll,
inside.
please. Drum roll.
Oh man, there's a lot of tape. I thought I got all the
I hope it's not the fish he was talking about. Month.
For a moment, I thought Chris had a knife, but it's just scissors. Just scissors. We're safe.
Just don't run.
All right. Oh my gosh, no way. Is this like ramen noodles? It is. Freaking ramen noodles straight straight from the origin, not those ones that we get here. Man, look at those. I was literally just craving ramen noodles today. That's awesome. All right, we got a little chinchilla or whatever you want to call that.
That's a twist.
Another one. What is that? What is this one called?
I think it's a
Hello
cat.
Kitty.
That's Hello Kitty.
That's what it is. So we got a couple Hello Kitties. Ooh, Cashy, look at that.
Oh,
I
cat jumping
claim that one.
That's going to be territorial.
Let's see. Grow.
That's a nice view.
Oh, this is Cash.
Cash, move your
This
butt.
is a
This
YouTube
one
video
is,
for her.
you water it and it grows looks like strawberries.
Wow, there's a lot in that box.
I don't read Chinese so well, so I don't know what this one is. It's Chinese. So this one is a bucket of something, China.
Bucket of something.
This one is a keychain. Let's see if Cashy likes that. No, he's not doing that. Let's see. Ooh, oh, this one's sweet. This one's going on the fridge. It's Godzilla magnet.
Ooh, that
Nice.
is so sweet.
Okay.
Cool.
Yeah, he's wondering. He's thinking of that.
So
Got
Damien's
a,
our merchant mariner out there collecting all of these goodies from places
Cash,
unknown.
you're really getting in the way. He thinks all these are for him. We got a kitty shot glass. And then we got Kit Kats. Oh gosh. Is that peach? Yeah, melon. Melon Kit Kats. Peach Kit Kats. And
It's like a never-ending box.
I know. Bookmarkers. So these are cool. Original bookmarkers. Yep. And that wraps it. So we got
Oh my gosh, that's awesome. Thanks, Damien.
Super cool, Damien.
very cool. Kit Kats.
We all enjoyed watching Cash.
Oh gosh.
These hello
All
kitties.
right. Peter Bay is saying, can you skip a PUA this year and then restart it next year? And if so, at the same amount or less?
Ethan leaned in the most. Go for it, Ethan.
Basically, yes. I always cover this in my first call with every new client when we do your 45-minute implementation. But yes, that PUA rider, we can drop that down. If you're paying annually, we can drop it down to $120 per year, or if you're going monthly, $10 a month. And then when you're ready to, you can put it back up to normal and typically make some catch-up payments for the times for the months or years that you went at that reduced amount. So yes. We wouldn't want to turn it down to 0. We would still leave it at 120. That's kind of the magic number to keep that PUA rider happy. But you're just not going to grow your cash value as much at that reduced payment.
But that is
I love
that.
that you can make it up.
That's that manageable floor, though, right? Like when we're talking about when you have the flexibility, you get the manageable floor,
Scale it
and you
up,
get the
scale it
meaningful
down.
ceiling, which is going to be all your PUAs in.
Yes.
You know, this in between is the cash you're growing.
Yeah. I actually just had I had a cool client that I did their first meeting for today, and they had an interesting design where they had it got issued with very little PUA on a monthly basis, and then it had a big term rider. So I forget who the agent was on that one, but they did it that way so that they could, whenever they had extra money coming in from working overtime or getting tax refunds or whatever, they could throw lots of money in. So I said, okay, you really need to find out. We're going to find out how much room they have available so they can put that extra cash into the rider and then use that then for their debt map, which we made for them.
That's a
That's
really
super
good
cool.
point that you brought up the tax return, because I know at like previous years, that's what I would just throw that right at a policy loan or something like that.
Exactly, Shauna. Yeah.
Margaret is saying, newbie here. I have $40,000 in savings and need to buy a vehicle. How soon after investing in a policy can I borrow from it?
Immediately. And then someone tell her what immediately means.
Within the first 30 days.
Yeah, we did that well. That was good. It's like we knew what we were doing.
All right. And then Eduardo is saying the 90-minute video says I could use IBC for debt and expenses. Can I put most, if not all, of my income into a policy?
At the start
Not
of
right
it,
away.
Whoa,
Yep,
whoa, 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 whoa. Just hold on a second. The 90-minute video does not say you can use IBC for. Oh no, you're right. It
Well, for
does.
deaths and expenses.
You're right. It does. Okay. I'm just trying to think through. I get so iffy on that expenses thing, but
yeah. Like, what are the expenses?
yeah. So it's vague. So could you use it for your debts? 100%. Could you use it for some of your expenses? Possibly. Definitely would want to have a discussion about that.
But I would just say this. I mean, if you're an insurance company and you have a client that wants a policy and you allow that client to put 100% of their income into a policy, is that risky for the insurance company? Absolutely, yes, it is. So they will not allow you to do that because it's too much risk for you and too much risk for them, because something happens to your income, then you can't pay the premium, the policy lapses, and that's bad business. So there's a limitation on what you can put in based upon their guidelines. So roughly between 15 and 25% of your gross revenue can go into the premiums deposits of the policy, generally speaking. Now, could you stack policies over time and eventually get all your income through them? Maybe.
And eventually your policy has enough growth where you're able to put more in as well, right? So like the longer you have policies, the bigger you expand your system, the more of your income you can get in. That's why I think Nelson talks about being like year 20-ish.
Yeah. I always got to remind myself that he talks about that in the book, but it's time though. It takes time to get to that point.
People have selective reading, hearing, viewing, everything else. They just see you can fit all your income into. I want to do that. It makes sense. And I think it's a tribute to what we do, teach, educate on the how we teach people how to do this, the process. But it's also some of that gets lost in translation. I got one of those questions today. Hey, can I just put all my income into this? I was like, no, you can't. It'd be like me saying, hey, I've got this 2019 F-150. Can I insure it for $2 million? And, just do that. And, you can't put everything through it. And Brian, where's 15%? I've always said 20 to 25%.
Lafayette.
Okay.
Up to 75,000 of income is 15%.
I did not know that.
He had a follow-up question too, which I bet you there's not then. I guess he said, is there a video explaining in detail how to put in most of my income into the policy? Sorry, the most difficult part for me is the implementation.
Yeah. I mean, think about putting 100% of your income into a 401k. Like they limit all these things for a reason, because, well, to be honest, most people aren't financially responsible, so they limit what you can do. So you don't kind of bury yourself. But yeah.
All right.
Oh, we got a few more. The video that could explain that, we do have a video, like a layering video, but you have to understand, if you were going to put all your income in, which we would never recommend, but you would do it over a series of years, like many years, and you'd be building these policies up and using these policies as you do. But you literally would never put 100% of your income in, because it'd almost be impossible. Because if you're doing the process that we teach in that 90-minute video, if you're constantly being the bank, your money's always moving and it's always earning more for you. So you're always bringing in more income. Now, as you bring in more income, you're opening additional policies. We call them branch offices. So that cycle continues, and you just keep adding more and more and more branch offices to your banking system, which inadvertently, I guess, could get to the point where, yes, then you are, putting almost 100% of your quote unquote income in, because some of the income isn't going to count as, your active income. Then the other component to that is at that point, let's call it after 10 years, those original policies you started would be so efficient. Then, as Nelson Nash describes in the book, Becoming Your Own Banker, you could effectively be paying your expenses, like your rent and groceries and all that stuff, from your policies. It wouldn't be really efficient, but you could, because that policy is so efficient in its point where every dollar you're putting in, you're literally taking more out than you put in. But that's going to be, depending on the policy, 7 to 10 years, where that effectively would be a strategy that could work. And he says that in the book as well.
A little bit. Deborah Ann is just putting a couple comments in. She's saying, I had many diagnoses of various things, but 14 years of reverse engineering on how I got ill and medical research, I've reversed my health issues. She was mostly on anti-aging, anti-inflammatory diet, and added all my deficiencies back to my body. So that is awesome. And that's what we're talking about for people who, you know, a diagnosis doesn't have to stop you from getting a policy. I'm sure you can get one. James is saying, when you can draw 90% of your initial dump into a whole life policy, what happens to the 10? Basically, why aren't you getting 100%? Because of cost of insurance, all this other crap.
Yeah, cost of insurance, you know, because the insurance company has to operate as a business to provide you the value that you're getting. That's what that 10% goes. So it goes to expenses, goes to some death benefit, by the way, and just various other things. So yeah.
Mm-hmm.
Yeah, the cost for the policies. I mean, we don't hide that. There's three costs: policy service fee, which is $50 to $100 a year; commissions, which we reduce by the way we design them, 60 to 90%, and then the cost of insurance. So wrap those in a highly efficient policy. That's roughly 10%.
And the reason you have access to up to 90% is because you're buying a rider, you're buying a term insurance, so it doesn't look like an investment, and that's how the insurance company is able to give you that additional insurance and still have that much cash value.
Yeah, so and listen, let me just end this. I don't mean to cut you off, Jason, but if somebody literally wants something that they can put they put money in and they have 100% access, there's a reason for that. This just isn't what you do. You just don't use this system. You just keep using a bank account. You know, we have to sometimes, I try to preach this a lot, you know, it's important that we understand who our client is not, so we can understand who our client is. And I understand clearly who our client is not. And our client is not somebody that wants to put their money in and immediately needs to take 100% out. And that if that's the case, that's because, well, they're not saving money. They're not following the first law of wealth. Therefore, start there, keep 10% of what you make, then redirect your savings, and then you won't need 100% of your money accessible in that. And if some people are just like, no, I save money and all this, and I just want all my money accessible. Okay, well, are you putting money in a 401k? That shit ain't accessible. So, you know, let's be real with ourselves. You know?
That's the person at Saturday at 9 a.m. He's at the bank waiting for the door to open so he can take out every single penny of his paycheck that just got direct deposited.
Yeah, it's a trust.
Yeah, that's like the guy that bitches about paying taxes on the gains on his stock portfolio. Remember that one, Joe? You know, I gave him the best advice ever. I said, all right, listen, keep your money in the markets, and then here's what you do. So you'll never have to pay taxes. You just wait for the stock market to drop. And when the stock market drops, which it will, you just wait till you're actually at a loss, and then you take all your money out. And then you pay no taxes. You actually get a write-off if you do it right. I mean,
don't call me no more.
I know that sounds idiotic. But like, listen, that's the mentality of some people. And I don't mean to say this the wrong way, but that was a Buffalo person. So a lot of these dumb questions come from Buffalo people. No disrespect to Buffalo, but shit, you know,
I don't think it's just Buffalo.
Walks like a duck and quacks like a duck, man. It's just a duck.
Chris, I want to laugh, you know, and love it to be Buffalo specific, but I've talked to enough people around our country. That's not a Buffalo specific thing. That's just a mindset.
More prevalent here in Buffalo.
It's a mindset thing.
It's more prevalent here in Buffalo.
Oh, and one other topic on that, and I don't know the intent of what why the person was asking the question, but the way I kind of look at this is, if I've got some money in my hand right now, I can go to the store and I can buy a bunch of tomatoes. Or I can go to the store and buy some tomato seeds, go home and plant them. And then in, I don't know, call it 6 months, I've got a bunch of tomatoes. And if I keep that plant going, I have more and more and more and more tomatoes. So this comes down to a short-term and a long-term thing. Can you take that cash and go do something with it at 100% right away? Yes. Are you willing to give a little bit up right now to get something greater in the future? And that's really what this whole process is about, is kind of giving something up now to get something bigger later. Way to look at it.
I love that, Craig. And then whether it's that, most things, if you take out money and anything, usually when you have to give up a little something in the beginning to get more later, regardless of the category, it's usually better off.
One thing with the terminology on the last question, he says draw. So I just want to make sure that he knows that we're borrowing the money, because he said, can you draw 90% instead of 100%? So we're putting 100%, $100 into the policy, but we can borrow 90. So that 100 is still in your policy. So when we do borrow our money, it's not coming out of the policy. It's actually coming from the general fund of the insurance company. So I just wanted to make sure that they might be new too. So.
Yeah. Craig hit that on the Wealth Wednesday webinar too. So if you come back on Saturday, we kind of explain all those buckets. That video will be live. Thanks for bringing that up, Joe. Shane is saying, oops, I'm sorry, I skipped over one other one. Sorry. Eduardo is saying, I have a pen policy. My first anniversary is in August. I won't be able to fully fund the PUA this year. Do I lose the opportunity to earn on potential gains on that?
Nope.
No?
No, I like to explain it's like as you keep paying in your premium, you're pushing that MEC limit higher and higher. And so there's a gap between what you funded and where the limit is at. And so when we check with the insurance company to find out, how much extra PUA can put in, we're just measuring from where you're at now to where the limit is right now. And then if you wait and go on further, that limit's just going to raise steadily. So unless anybody else unless there's something I'm missing for Penn Mutual specific generally, that's how I like to explain making extra PUA payments up to the MEC limit.
Does he have to put it on the anniversary year? Why can't he put in everything he possibly can into the PUA and then 3-4 months down the road add more PUA?
No, he's just saying he's not going to be able to fund the PUA. So he's worried that because he's putting in the base, I think that's what he's saying, because he's putting in the base, he's not going to get the same kind of growth because he's not adding the PUA. And Ethan's just saying, no, you're going to be able to add it in later.
Yeah, there's not an expiration date to that.
He'll still be able to put it in though.
Yeah.
Yeah, the piece I'm confused on in the question is
The last
you lose
line?
the opportunity to earn on the potential gains on that. So if it doesn't get put into the policy, of course you're not earning on that, but it doesn't prevent you from adding it in later and then start the growth from that point forward.
Yeah. So yeah,
Correct.
that's a part I was stuck on too, Craig. But you just saying that made it clear where when the money goes in, Edgardo, that is when the money starts growing. So if there's a gap of the time that you didn't put it in, it's not growing until it makes it. You'll still have the ability to put it back in. Is that clear?
And that is what the dividends and interest are built on, the PUA.
Well, your dividends have base too. It's part of it too. So.
Love it, love it. Okay, and then Shane is saying, I'm a fan of PMC. Curious what each of you are lending on at this time, including outside the box opportunities. Who wants to start?
Yeah, we're all doing something different. I bought a bunch more treasury bonds today because they're literally dropping like a rock. So that I bought today on Private Money Club. You know, I haven't lent on anything on there recently, just because I'm just a lot of my money's already lent out. But the things I am looking at are, you know, I always love single family rentals or, you know, like small, simple fix and flips, Chris Rude styles. I love right now. Affordable housing, like mobile home stuff, like Chris Rude or Christy. If Christy would just give me an opportunity. I mean, the thing with Christy and Noah is they never, you know, they're always raising money, but they always have like a line, just a long line of people that will lend. So I haven't got that opportunity, but I would lend on their mobile homes in a heartbeat. And then, you know, the stuff I do with Arthur Marshall, that's been phenomenal for me. I mean, I'm not making an investment recommendation, not endorsing that or anything, just saying I put my money in it. It's been like freaking clockwork. I think, Shauna, you do the same thing, right?
Yeah, I'm with Arthur, and I'm also with other stuff.
I know we're so hesitant to say anything. You know, let me repeat that. We are not making investment recommendations, giving investment advice, suggesting that. Please do your own due diligence. Consult with your attorney, advisor, and everybody else under the sun.
And moving on.
No, but seriously.
That was good.
And call PMC Wealth when it's ready to go.
And Stephen Nagy's always getting new silver, you know, showing up on his desk. He's always showing us here. So.
I'm investing in kitty cats.
That stuff's for fun, though.
And Craig, I was looking at your net at risk. I'm learning stuff from you every week, man. So I'm learning, how much is at risk, how much has come back, and all that stuff. So figuring all that out.
Yeah, and it kind of comes down to getting comfortable with how much you want to have out there working, and some people are more comfortable with a higher number or lower number, but I think we're all doing similar things, and I'll just be flat out honest. There's some things that aren't working right now. I'm not concerned about them long term, but there's some things that aren't working, some things that are. And the things I really like, to your point, Chris, are the lower income housing. And there's a guy I'm working with. We just finishing up another deal, going back into another one. So he does a lot of fix and flips, gets properties for rentals, and then refinances. So, but I'm probably sitting on more cash than what I've typically sat on, just because I'm a little nervous.
I thought Chris had said that not that long ago too, that he was sitting on more cash this year because opportunities are coming.
Okay, here I can say, you know what I'm investing heavily in right now? My own businesses. Yeah. Like I am investing heavily in like business opportunities that we are developing. So Craig and I are investing pretty heavily in something that you all hear about later. I'm investing heavily in PMC Wealth. Going to be investing it heavily into PMC, I'm sure. So like, I'm just putting a lot of my cash in my own companies.
Yep. Betting on ourselves and building things that everyone can use. So,
well, that is the first business we all need to be in, is the business of making money. And how can you better make money is with the stuff that like, and understand and are doing, right? So, and then the second business is what?
Banking business.
There we go.
Yeah. I've read that book.
I mean, just simple principles. We come on here every week doing Ask Me Anything, but it's basically within, 5 different principles that we're speaking through lenses, and we're just talking about changing one thing. And we come every week and we have hour-long shows talking about changing the one thing. And most of the time it's about loving ourselves more, just like paying yourself, stop being last in line for your money. Like if you're listening and that resonates, think about that. Like stop being last in line for your money. When you get paid, everyone else's hands in your pocket, it's all gone. You're like, hey, what happened? Well, you put everyone else first.
That's actually, you brought up something too that I forgot that I'm investing in, which I've invested in myself, because I can't remember if that was Napoleon Hill or Earl Nightingale, but like investing in specialized like education. So I've been doing certain training groups and things like that. Like everybody, like the people who do PMC coaching and stuff like that. I'm in some certain groups to kind of strengthen my skills and all that sort of stuff too, that I believe will bring me more active income, in the next few months.
Well, our family is going to be growing. It's shrinking and then growing. We've got a Ford F-250 on the list coming soon.
Not where I thought you were going with that.
I thought you were about to be a grandfather.
Me too.
Haven't heard those news. So we had our main truck that we use for hauling crap around. It's done. So if you've had a Ford problem, it's actually kind of wild, but it blew the spark plug out of the hole, stripped all the threads out of the head, and anyway, engine's done.
May it rest in peace.
May it rest in peace. So we're gonna have a funeral for that on Friday.
In peace.
Part of that. So.
And then James kind of came back, which I would like to hit back on, is he's saying, I wasn't looking to take all the money out at all. I was just wondering what happens to the 10%. So I dumped in 50,000, but my loan amount was around 44,000. So the 6,000 goes to fees as well as the premium. Or my thought is, don't you kind of get it back like over time? Like, yeah. I don't know.
But it's still, like you said, it's still a fee up front. I mean, with a PUA dump in, they do it's called a load, and that is a premium load that they get. Some of that is commission, so the commissions on PUAs anywhere 1.5% to 2.5%, give or take, to the agent that does that. So there's that. So you could factor that out, and then the rest is the load that the insurance company charges.
Which bought you life insurance too?
Oh yeah. It's all playing into the same thing. Correct.
Yeah.
And at the end of the day, we want some money going to the insurance company because they have been doing things with their money and, you know, with our money and all the things pulled together to make everybody more money. So, you know, it's
Make
like
sure
a
they
nice,
can deliver on all the guarantees. Right?
yeah, it's a nice thing to contribute to. And they've been doing it for longer than we've been alive. So sometimes it's nice to say, hey, you take this ball and run with it.
If you look at your illustration, you see that you don't get all of it out in years 1, 2, and 3, and then it becomes efficient in year 4. The amount of money that you make in 5, 6, and 7 equates to what you lost in 1, 2, and 3. So somewhere between 7 and 8, every penny that you run through, you now have more access to than what you even put in. So it depends on the way that you're looking at it.
Joe, I'm always impressed that you can just speak numbers like that. I mean, Craig, like time 3 today is a freak in the sheets, but I know you can't use a spreadsheet. So it's all happening in your head.
All up here, brother.
One last thing too on the dumping piece, so like you put in, you know, the dump of 50,000 and then, you know, 44 or something is, or a little bit less is available right away. Look at your illustration and look at that guaranteed cash flow, because that's always an end of your number, you know, 12 months later. So yes, you can take a loan in the first 30 days. But because that compound interest is still working for you, even if you pay all your money in an annual plus a dump in at the beginning of the year, it's still slowly growing through you all year long for the next 11 months while you're doing nothing. So there's always a difference between, you know, month 1 and month 12 on the illustration.
Oh, very good point, Ethan.
And I'll just respond to Christian's thing right here. Christian, yeah, I responded back to it. So yes, I got your email yesterday. I did respond back to it regarding Ted Thomas. So hopefully you got that response, but let me know.
Yeah, and Christian, I still haven't received your email, so I don't know. I know you mentioned something on Wealth Webinar today, but should just be craig@chrisnoggle.com. Give that a try.
All right, and then did we get to this? I can't tell if he has a policy already.
Penn Mutual, yeah.
Okay.
So Ethan Evans.
And I think that's it
And
right
at
now.
moneymultiplier.com.
Okay. Oh yeah, I see it on the screen.
I was trying to respond
well,
to the chat, but
And Dex, I laugh every
Doesn't
time I hear
work.
that too. That's why I wanted to say it 3 or 4 times. And I think Craig would laugh and maybe blush a little bit, but he might be a robot, so I'm not sure.
The freak in the sheet. Yeah, I mean it's one of those nicknames I wouldn't have picked out for myself, but it seems to stick.
It's a good one.
It's too good.
That's like Joe and I standing out in the hallway and like, oh, it's Joe Helock and Craig the freak in the sheets. It's like,
Oh, what a tandem that is. They need their own show. Freak in the Sheets and Mr. Helock.
Well, there you go.
Wow.
All right, I got to hop to a call.
Yeah, we're at the top of the hour. I think we did all the questions right now. Any final words?
I would like to invite Justin out to maybe come and put that helicoil in the aluminum heads. But yeah, we thought about doing that, but the thing's got 280,000 miles on it. I think it's just done. It's just done.
I'll sell you my Chevy Suburban, Craig. I'm trying to get rid of that one.
What's that?
I'll sell you my Chevy Suburban. I'm trying to get rid of that one.
No, we need to get something that pulls the trailer, so it's going to be the 250. But
Oh, okay.
I appreciate it.
Anything for you.
All right.
All right. Well, thanks everybody for all your questions. I know we got off to a slow start, but it came around, was positive at the end. So we'll see you on the next one. Thanks for joining.
Have a good one.